So today we're probably going to come at a different angle than a lot of the other speakers in this event. First of all, I'd like to thank Wealth 365 for inviting me, and Marissa's been great in organizing all of this. My name is Carley Garner. I am a futures and options broker at DeCarley Trading, as Marissa just mentioned. We are going to kind of talk about like macro views of markets and also some ways you may want to hedge your portfolio risk or speculate, depending on what your goal is. You can use the same strategies to speculate as you can hedging. It just depends on what your portfolio looks like and what you're trying to do. We're going to talk about things like gold, crude oil, equities, and some of the bigger picture things that I'm looking at that seem a little dysfunctional to me. I know everything seems to be firing on all cylinders in the markets, but I see some things under the hood that make me a little bit nervous. So we're going to talk about that. If you have any questions or anything, this is my phone number, my email address. You can reach us at decarleytrading.com. That's obviously our website. We're basically a boutique brokerage service. We offer futures and options. We don't offer stocks or bonds or traditional assets. We're a futures and options broker. If you're looking for educational material, you'll find it there. If you're interested in our newsletter, like if you don't want to use us as a brokerage, but you want access to information that we provide, you can check us out on Substack. I mentioned I'm from Las Vegas. This is my dog Frankie. I'm going to be super quick here, but this is obviously the famous Las Vegas sign. That was during COVID. The entire strip was shut down. That's the only reason I took that picture. Otherwise, I would have had to stand in line for a couple of hours. And one last thing, I probably should have taken this out because we're on a time crunch, but most people think of Vegas as desert. This is actually Vegas, believe it or not. This is 20 minutes from my house, hiking in the mountains. And one last thing real quickly, I do provide a lot of content to Jim Cramer's Mad Money, Bloomberg Television. I'm on RFD TV. It's a rural station that some of you may or may not have heard of. If you're a farmer or a rancher, you probably have. And the newsletter that I mentioned to you on Substack is the DeCarley Perspective. It's there in the lower right corner. Our clients receive that for free, but you can subscribe via Substack. And let's talk about markets. Oh, I'm sorry, one last thing. I've written multiple books. If you do have any interest in any of the things that we talk about today, and even obviously go a little deeper, these are the three newest books that I've written. You're going to see others. Ignore all the others. These are the only ones you need to pay attention to. The others are outdated, old publishers, so on and so forth. Lastly, what we are talking about today is speculating and hedging, but mostly speculating, and there is it's a substantial risk of loss. Trading is not for everybody. Trading commodities is certainly not for everybody. Okay, first I'm going to start out with, because I'm a commodity broker, take this with a grain of salt, but here are the advantages of trading futures versus trading stocks. And I'm not saying everybody should trade futures. I just got done saying most people probably should not trade futures. It's leveraged, it's unruly, it's not for everybody. Not everybody has the ability to manage the leverage properly. And even those that do find it's a very difficult game. So I'm not trying to say everybody should speculate in futures, but there are definitely some advantages to speculating in futures versus stocks if you decide to take on that type of trading. 23-hour market access, free leverage and margin. If you want to short a market like the S&P 500 or the NASDAQ, you can just hit the sell button and go short. You don't have to borrow shares. You don't have to pay anybody interest. You just go short. It's that easy. If you are buying the S&P 500, you're buying it on leverage. You're only putting a small amount of money into your trading account and having the ability to purchase let me give you an example just to make it simpler. The current margin on an E-mini S&P is about 24,000, and let's see, the current value of an S&P contract is about 345,000. I should have known that off the top of my head, but the market moves so fast the numbers run away. So you can imagine how much trouble you can get into, or how much money you could quickly make with that type of leverage. Putting 24,000 down to control or benefit from roughly $350,000 worth of stock. So that's leverage. It can work for you. It can work against you. The great thing about futures is you can use that leveraged futures account to hedge your stock portfolio. So if you are long, let's say $350,000 worth of S&P 500 stock, maybe it's the SPX, maybe it's the SPY, maybe it's Vanguard's index fund that tracks the S&P, whatever it is, you can either sell futures contracts to lock in your price. If you did something like that, I'm not saying that's the best way to go about it. I actually have better ideas. But if you went short a futures contract at, let's say, 3,900, it would lock, or I'm sorry, 6,900. See, the numbers get away from me. If you sold the futures contract at 6,900, you're locking in the price of your portfolio. As the market goes down, your futures hedge makes money while your portfolio is losing money, and vice versa if it goes up. But you're not creating a taxable event. If you sell a futures to lock in your pricing, you don't have to pay taxes on your gains, right? You're not selling your stock and paying taxes on the gains. Also, you're still earning the dividend income. So futures can be an amazing tool. They don't have to be for leverage speculation. I'll just mention one more thing. If anybody wants a copy of these slides, they can email me and I'll send them over to you because I'm kind of skimming through some of the stuff. But another thing to keep in mind is if you're speculating in futures, whether you're trading crude oil, gold, S&P, whatever the case is, you're actually going to benefit from a lower tax rate than you would if you were doing the same thing in most stocks. You get a 60-40 blend between long-term and short-term capital gain, and you only report one number to the IRS. You're only reporting how much you made or how much you lost. You don't have to do each individual transaction. That in itself is a massive benefit. And I'll mention something real quickly. If you are somebody that wants to speculate in crude oil, let's say you have an opinion in crude oil, you want to express it in the market and try to make some money off of that opinion, you're better off doing it in the futures markets than you are an ETF. And the reason I say that is most commodity ETFs, they pool investor money and then they turn around and go buy futures contracts with it anyway. So you as an investor or a trader, however you want to, whatever you're trying to do, whatever your goal is, you can go directly to the futures markets yourself and you can go long crude oil in a much more efficient manner. You don't have to worry about management fees. You don't have to worry about inefficiency of rebalancing. You're just long crude. You're either right or you're wrong. And you don't have to use leverage. Most people assume they have to use leverage, but you don't have to. You can overfund your account and eliminate all the leverage. And what I mean by that is there's a micro crude oil futures contract that's 1/10 the size of a regular contract. And so what that does is it allows somebody with, let's see, crude, I'm just going to assume crude oil's at 60. So with a $6,000 account, you can go long one micro crude oil with zero leverage because that micro crude oil is only worth $6,000 in nominal value. If you wanted to use leverage, technically you could buy a micro crude oil for as little as, I think the margin's $700 or $800. So if you really wanted to lever up, you could open an account, put in $800 or whatever it is, go along a micro crude oil, and you're going to get a lot of bang for your buck, but you're probably going to blow out your account also. So again, leverage can work for you or against you, but you don't have to use the leverage. It's optional. Just like if you're at a buffet in Las Vegas, you can get 10 desserts or you can get one. It's optional. You don't have to indulge yourself. So this is a chart of the NASDAQ. This is the NASDAQ futures. The NASDAQ futures is based on the NASDAQ 100, so don't confuse it with the NASDAQ 150 or any other version of it. I'm showing you this just to give you an idea of where we are because it's really easy to get caught up in all of the exciting things that are going on, the AI rally, all, the Magnificent Seven stocks, all of these things are very fun and very exciting, but they're not guaranteed to persist. And they are, the one thing that I can say, I don't know what's going to happen next. I don't know how long this euphoria lasts. I don't know whether it goes on forever or goes on for another day. But what I do know is, historically speaking, when we've gotten this overstretched in the markets, in fact, we've never been this overstretched, there's a lot of risk in participating. And I think that a lot of educational content and literature and things that we see on social media is highlighting the rewards, but not highlighting the risks. So I just want to open everybody's mind to the idea that maybe this might not be a time to press the gas. Pressing the gas has worked very well in the last few months, but that doesn't mean it's always going to work. I've seen horror stories. I've seen people make and lose several $1 million during the dot-com bubble, prior to the financial crisis. So the only thing I do know about markets is they're unpredictable and they come with risk. So I'll just leave it at that. Just to give you kind of an idea of what the purpose of this chart is, it's to show you that my premise is, had we not had the pandemic, had we not had massive money printing, money supply injections by not only the US government and the Federal Reserve, but by overseas central bankers. Had that not happened, the market probably would have maintained a normal trajectory, and you can see it's far less exciting and far less impressive than what we've seen. In fact, there's probably a chance we would have stayed between this black and blue line. I'm hoping you can see my cursor. You can see this black and blue line here. In a normal market and in something that is historically normal, we probably would have stayed within that range. Now, obviously, we're not in that range. We're far, far, far beyond. And maybe we stay up there. I don't know. But the reality is, this market was juiced up and it is what it is. It took us 10 years to travel as much as it did 20 months after the injection, which happened here. This is where all that money came into the market. It took us 20 months to have 10 years worth of price action. And this last rally is actually even more impressive. 12,000 points in the NASDAQ in 2 years. So again, just kind of raising awareness. There are some flags waving. I know that that doesn't mean that the market peaks out tomorrow and maybe we run another 20 cents before it runs into trouble. I have no idea. I don't have a crystal ball. But I know it's time to pay attention to risk and not be complacent. The one thing I've learned in these markets is complacency kills. And something that sticks out to me is I follow the RSI pretty closely. RSI is showing that we are overbought in the NASDAQ on a monthly chart, and we've been making lower highs. Again, you can see this is going on years, almost a decade from 2017 through now. So I'm not saying that this happens tomorrow. I'm just saying be aware of any money that you're putting into equities, stocks, specifically tech stocks. Your time horizon needs to be pretty lengthy. If you think you might need the money in a year or two, you might be making a very stressful mistake. Not investment advice, just kind of a warning. I've seen this before, unfortunately. I'm sure that anyone that's spent any time running through Financial X, Twitter, or reading most financial literature, you've probably come across the idea that the stock market and many asset prices follow the M2 money supply. That's how much money is sloshing around the economy. Again, as I mentioned before, we had this massive injection of cash in January of actually March of 2020 that allowed the market to recover and eventually put us on the trajectory that we've never seen before in the equity markets. And it's really, I mean, there's a lot of things going on. I'm not saying it's this simple, but it's almost this simple. It's almost just too many dollars chasing too few assets. And some of you might be thinking, but that money doesn't have to make it to the market. And you're right, it doesn't make it immediately to the markets. It goes through, 90% of the economy is probably living maybe a little beyond their mean. I don't want to say 90%, that's not fair. Probably 50% of the economy is living beyond their means a little bit. They're not saving, in other words, they're not savers. If they are savers, they might be doing something like putting money in the stock market and running up debt on their credit cards. I've heard of many people doing that. So all I'm saying is eventually the money that's printed makes it to the stock market and we get higher prices. And you can see the correction in 2022 followed pretty closely to M2 money supply. But the interesting thing is now the M2 money supply is actually, it's on an upswing, but the stock market rally that we're seeing here in the last couple of months is actually outpacing the M2 money supply. It's something we've never seen. In fact, it's more extreme than it was during the dot-com bubble. That doesn't mean the S&P can't go to 7,000 or 7,500 before things calm down. Irrational markets they have no limits. Again, this is just kind of a word of caution, not a sell signal. And I know the consensus estimate is that Warren Buffett and his investment methods are outdated, but the reality is until we have his net worth, I think we probably can't really judge, right? According to Buffett's indicator, it's super simple. It's the total US stock market value divided by gross domestic product. According to that simple metric, the market is beyond 2 standard deviations of what it normally should be trading at. In other words, we're wildly, wildly overstretched. The last time we saw it this overstretch was right before Liberation Day, and we had that really massive, very quick pullback. I don't know if that repeats, and if it does, I don't know if it happens tomorrow or if it happens next year sometime, but it's something that we should kind of expect because it would be very unusual. You can see we've only really toyed with this level a couple of times historically. This goes all the way back to 1950, and you can see it's only hit the red line a couple of times. And each and every one of those times have been opportunities to lock in profits and protect wealth, not press the gas on investments. And I know I'm sounding like a Debbie Downer, and again, I'm not a pessimistic person. I'm not a perma bear by any means. I'm actually almost always positive and bullish. I just have seen too many people get too complacent at bad when they shouldn't be, and I'm hoping to prevent that from happening to some of you. This is a chart of the Nikkei. The Nikkei had a euphoric rally in the 1980s. I was in elementary school. I remember the push then was everybody should be, forget about learning Spanish, learn Japanese because they're basically going to rule the world when you grow up. And that was basically, it made sense because that was during the euphoria in their stock market. And guess what? I'm not saying this happens in the US. I'm just saying this can happen. Euphoric stock rallies sometimes take decades to regain. And what I mean by that is you can see we peaked out in 1990. We bottomed out in the early 2000s. One time came back and retested it about 8 years later, and then we finally started to rally. What this tells me is stock markets, when they get over their skis, what they're doing is basically pulling forward prosperity, pulling forward gains. With that said, you could imagine a less parabolic chart in the 80s. If it was just a steady eddy incline, it'd be completely reasonable for this index to have gone from 10,000 to 40,000 over the course of 30 years. But because it went from 10,000 to 40,000 in a couple of years, it had to give a lot of that back and run some time off the clock before it could get to something, a mathematically sustainable valuation. So as we're chasing stocks higher because it's fun and exciting, we should always keep these things in the back of our mind and make sure we're managing our risk properly. A very smart trader once told me, it's not how much you make, it's how much you keep. And that is so true. As someone who has seen family members lose everything, multi-million dollar portfolios in the financial crisis, I myself suffered not losses to that magnitude, but I was young and dumb and complacent and had a pretty big setback myself. So maybe I have a little PTSD. This is a big view of the stock market versus treasuries. And the reason I point that out is something is amiss. Now, a lot of the dysfunction that we're seeing in the markets today is because the government stepped in and started manipulating things. They've manipulated interest rates, they've manipulated the stock market. When things were a little rough in 2020, they came in and put the Fed put in place to make sure that markets didn't go down. Because they know if markets go down, people feel less wealthy and they spend less money. So it's really as simple as that. So the government and the Fed has decided if they keep assets increasing, even if they're increasing too much, people feel wealthy, they spend money, and it keeps things afloat. But in the long run, we've seen this blue line in the middle is kind of the gravity check. Current valuations, either the stock market is way too expensive or treasuries are way too cheap. I think it's probably a little bit of both, but only time will tell. As we can see, the markets are eventually going to gravitate towards each other. The spread between these two markets is generally not this wide, and it generally hasn't been sustainable. So the purpose of this chart, this is a 30-year bond monthly chart, and I'm not telling you to go out and buy all the bonds in the world or all the treasuries in the world. What I'm trying to show you here is just because everybody is doing something and just because everybody has a certain opinion doesn't mean everybody's right. You could see in 2020 when all heck broke loose, I mean, we all know what happened in 2020, everybody wanted to own treasuries. People were scrambling to buy treasuries at an almost zero yield. The 30-year was paying 0.5%. It was less than 1%, yet people they couldn't buy enough. A few months ago, with treasuries paying 5%, nobody wanted them. So this is just kind of a lesson in sentiment. Just because everybody wants something today or doesn't want something today doesn't mean that that's a permanent state of mind or a permanent market state. Prices are temporary. And again, I'm giving you big picture views, not daily, weekly, or maybe even monthly. These are just multi-month or maybe even multi-year views. But be very, very careful wanting to buy something because everybody else wants to buy it, or sell something because everybody else does. Most people are generally wrong in the markets. That's the reality that I've come to, and I wish that wasn't true. So obviously this is the most impressive and fantastic bull market that any of us have ever seen. I mean, this is really one for the history books. We'll probably be talking about this for a long, long time to come. What's going to be more interesting is how it ends. There's two ways for this to end, and it's not all bad. In a perfect scenario, in my opinion, we've come too far too fast. So similar to that NASDAQ chart that I was showing you. So the S&P, not surprisingly, has traded out of bounds. This would be a normal price range, a very normal, reasonable price range. If we followed this pattern, and I believe we would have had we not gotten all of this money supply here. I mean, to give you an idea, money supply grew from 2020 to 2021, it grew 40%. On a normal year, money supply grows 6 or 7. It was just a bazooka of liquidity, and that liquidity had to go somewhere. And we're just noticing it's going into very specific places, in my opinion, and I'll show you a chart soon. It's Bitcoin, gold, stocks, and even a few commodities. Coffee and live cattle seem to be targets as well. But without this liquidity, I think we probably would have stayed in this range, and you can see that's a range between 4,800 and 3,500. These are really different numbers than what we're talking about today. At 6,500, I believe we're kind of off the charts here. We're at about 6,800 now. So we are off the charts. Does that mean we have to roll over tomorrow? Absolutely not. Markets can trade outside the lines for a long time, and sometimes they stay outside. You'll see here, I just mentioned, if without this bazooka of liquidity, I think it probably would have stayed within this boundary, would have stayed below this black line here. So it broke out, traded out of bounds pretty heavily here, and didn't really stop until we got much, much higher. So maybe this is just going to reprice, and we're going to start drawing some other trend line to try to keep up with it. So we don't know yet. The jury is still out. But we are, again, seeing some flags here that would at least suggest a pause. Again, the market doesn't have to come back into this range. We don't have to go all the way to 4,800 or 3,500. We can really just run off a lot of time trading around. Like just trade. We might, for example, after the financial crisis, we rallied and we traded sideways for 3-4 years to run off some of what people thought was frothy. So right in this period right here, that was, let's see, from 13 to 16, that was about 3 years of a whole lot of nothing. So when markets get overbought, they don't have to pull back sharply. They can just kind of run the time off the clock and get to more realistic valuations. But if we do have some sort of reason to correct, don't be shocked if we see low 5,000s or maybe even high 4,000s again. We're getting kind of two stories in the markets. Stocks and Bitcoin are acting like there's growth and prosperity. Gold is acting like something's broken in the system and acting as if there's a bunch of inflation down the pipeline. But if we look at a commodity index, this is the Bloomberg Commodity Index, it's trading at about 106, which is only slightly higher than where we were from in like the 2016 to 2020 area. And if you take the metals out, if you take gold, silver out, we're actually trading where we were prior to 2020. So commodities in general are in the dumps. They are not screaming inflation. Crude oil, natural gas, the grains, they are all at multi-year lows. So something's not right here. If things are as good as the stock market says, commodities shouldn't be in the dumps like that. So if you were somebody that studied portfolio theory and you followed the 60-40 bond portfolio, probably have had a rough 5-6 years. Government intervention in the markets, government control of interest rates, and then equity markets have completely really decimated the 60-40 portfolio. And I'm going to show you an example of this. So while anybody that's chasing the Mag 7, well, I shouldn't say chasing, you've done very, very well, so congrats. Anyone that put money into like concentrated sectors, tech stocks, has done very, very well in the last couple of years. But if you were somebody that had a textbook diversified portfolio, this is a 60-40 portfolio by Vanguard that's like auto adjusted, you are just getting your money back from the 2022 correction. It's hard to believe, but that is exactly true. Can this last? I don't think so. I think it's probably temporary. We've historically never really seen that before. Okay, so we're going to shift over to gold because gold's been a very interesting market. Gold is trading in a way that we've never seen gold trade before, with the exception of 1979. I was only 2 years old, and I'll be the first to tell you I've been wrong in gold. I'll show you the chart that I was working off, and I'll show you where my mistake was. I did not anticipate gold behaving the way it is. I'll just be 100% honest. So we've taken some heat on this, but gold is kind of doing, it's not doing what it should be doing. I'm not saying that I'm right and the market's wrong. The market's always right. But let me show you a couple things that are a little bit off. So this is a chart comparing S&P 500, gold, and Bitcoin. You can see S&P is in blue, gold and yellow, red and Bitcoin. So a lot of people are buying gold and Bitcoin thinking that they're diversifying. And I think this worries me because, first of all, there's a lot of leverage built into the market anyway. There's more people holding stocks today than there ever have been. There's more dollars long stocks on leverage. The world is long stocks. And I think a lot of them are purchasing Bitcoin and gold, thinking it's going to diversify them. If stock market corrects, those two assets might help them out. Bitcoin, I think, has kind of proven itself to be a risk asset. It has followed stocks almost step by step over multiple years. But this might surprise you to see that gold and the S&P are very highly correlated. You can see since 2020, when liquidity came into the market, they've started to become more and more correlated, and this last 2 or 3 years have been superbly correlated. If you look at the last few months, they're trading in the 90 percentile. So they're basically trading as if they are the same asset, which is fine. If you're long stocks, gold and Bitcoin, you're just hitting it out the park. If any of those start to roll over, they probably all roll over together. And so you're going to be getting hit on multiple fronts. So just something to be aware of, not a reason to completely change your entire thesis, but want to make sure people understand the risks that they're taking and understand that these risks can be hedged. So I'm hoping to get to a couple of examples. And one of the primary reasons that I did not, well, there's many reasons, but this is one of the biggest reasons I didn't expect gold to behave this way. And it is, gold is a competitor with treasury bonds. Basically, there's two risk-off assets. If somebody has money that they want to invest, but they don't want to take a lot of risk, they generally choose between treasuries and gold. Gold is an asset that does not produce earnings. Gold does not produce income. Treasuries do produce income. So if you buy treasuries here, at the lows it was over 5%, but now it's closer to 4%. You're earning 4% a year. You don't have to rely on treasuries going higher to make money. You earn 4 or 5%. I'm not going to say risk-free because there's interest rate risk if you need to cash out early, but very, very low risk. Gold does not pay dividends. So if you buy gold up here, the only way to make money is if it keeps going up. There's no parachute or cushion. If gold corrects sharply, you're going to feel some pain. And if you have a choice between buying an asset that's overbought and pays no dividends or interest, or an asset that's a little oversold and pays 4 or 5%, the mathematical answer to that question is treasuries. But people are acting on things that have nothing to do with math. It's an emotional, it's a lack of trust in the system. There's all types of reasons people are buying gold instead of treasuries. But if you look strictly at the math, it doesn't make sense. And just like the treasury chart that I showed you a little earlier, people are very interesting. Humans it's always the same. Everybody wants to buy an asset after it's already made its move. So this is 2011. This is a monthly chart. In 2011, gold made a parabolic move, and everybody wanted to hold gold. Our phones were ringing off the hook. My mom, my grandma, everybody wanted to buy gold here. Nobody wanted to buy it here. Nobody wanted to buy it here or here. Guess what? Now everybody wants in here. Unfortunately, my favorite uncle has passed away, but I can guarantee you my phone would be ringing and he would be wanting to buy gold and silver here. You know, human nature is when things are going up, people want to buy it. When things go up dramatically, more people want to buy it. And so it's a matter of running through the system. Here's where I was wrong on gold. I was expecting this trend line here to hold. This is a decade-long trend line. When gold got to this level, treasury yields were near their highest. We're overbought, we're up against a trend line. Everything told me this was a good place to be a gold bear. So we were bullish up until here. This is where we turned bearish. That was a mistake. Mistakes happen. Sometimes I'm wrong. I'm not going to pretend I'm always right. But I will say, if you do own gold, you should be hedging your exposure, taking some off the table, taking a profit. Even if it goes higher, the risk is very substantial from here. You can see the RSI. We've only seen gold over overbought like this. To be technical, we haven't seen gold this overbought since 1979, but we haven't seen it in the vicinity of this overbought very many times throughout history, and each time has had a pretty big correction. This correction here from 2011, it was a blow off top. We corrected 45%, and it took a decade to recover it. So I know this is going to sound super crazy. You probably think I'm an idiot, but the reality is gold is a boom and bust market. It is most likely going to take a 40 to 50% haircut at some point. It might not be right away. Maybe it takes a year. I don't know. I wish I knew. But that's how this market operates. And I'll finish by saying this. In 1979, when we had a blow off top, very similar to what we're seeing now, gold corrected, I think 60%. And anyone that bought the highs of that parabolic move didn't get their money back for 28 years. So I said this on RFD TV a few days ago. If your time horizon is 50 years, this might be a good time to buy gold. If your time horizon is less than 50, odds are you're probably going to see much better prices to get long from. Gold is the type of market you want to be long and you want to buy when nobody else wants it, not when everybody else wants it. That said, again, I've been wrong. I can admit it, but I still wouldn't. I don't think it's very safe to chase this market. Gold is only a safe haven until it isn't. So let's talk about crude oil. There's a lot going on in this chart, and I'm going to try to be quick so we can look at a few market examples. The big takeaway from this is I want people to understand crude oil is in a bear market more than it's in a bull market, for starters. Like, we've seen some really big dramatic rallies. In 2008, we got up to $150 a barrel. My mom actually bought a Prius the day before it topped out. She told me oil prices and gas prices are never going down again, so she's buying a Prius. And we've yet to see $150 oil again. We got pretty close. This is when Russia invaded Ukraine up here, but that too was temporary. Since fracking, you can see this black line here. I call this a fracking line. After fracking was invented, we've basically stayed below this line, and I think that will continue because obviously fracking adds supply. Another thing I'm going to point out in this market is this blue line here is 65. Nothing good happens in oil under 65. It just doesn't. You can see it's a significant pivot, and that's probably because a lot of U.S. producers we're the top producer in the world at this point, producing country, I should say. A lot of U.S. producers, their break-even points around 60, 65. Some of the offshore stuff is much lower. The interesting thing is there's some French producers in the Middle East that can do it for under 20. So what happens is once you get to 65, the market often becomes quite volatile. Above it, it's bullish, but below it, which we've been trading below now for a few weeks, it starts to get very heavy. And on a few occasions, we've seen some really massive sell-offs. The 2016 bear market in oil, 2008 bear market, and then of course we all remember COVID where oil went negative. As long as oil's below $65, you want to be very, 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 very careful having downside risk exposure. In fact, we are kind of assuming that rallies are to be sold, not dips to be bought, at least until we can decisively hold above 65. This is a weekly chart of crude oil, and you can see in 2022, when Russia invaded Ukraine, things got really out of hand, just wildly volatile, but we've basically been putting in lower highs since then. And I've had this target for a long time, and you can see we're just going nowhere. It's been super boring market, but I believe we are going to below 50, probably mid to low 40s, depending on how long it takes for this pattern to hold. Again, this is the 65 area here, and we know 65 is pivotal. You can see just how market tends to either bottom or sell off from there. So below 65 is bad news, and I think we probably go lower. So just keep that in mind if you are speculating or have some oil stock exposure. Maybe you might want to hedge in the futures markets. Okay, I'm going to go to a few market examples here. So this is the newsletter that we publish for our clients and also for our Substack subscribers. And first we're going to talk about gold. We put this trade out on, I want to say last Thursday, but it might have been Friday, so don't take my word for it. But late last week, we put this out as a recommendation. Now, looking back, today gold was up $70. I really wish I would have waited a couple of days. But the picture hasn't changed for us. So for those of our clients that either want to be bearish gold in an aggressive way, or for people that are, let's say, holding gold bullion. I don't know if you've ever tried to sell gold, but if you're holding bars or coins and you try to, of any type of size, I'm not talking like one little bar or a couple coins, good luck selling it, especially at these prices and with the market volatility. First of all, you're gonna have to carry it and drive it to some shady neighborhood in downtown Las Vegas. Second, it's really hard to sell at a decent price. Let me just say this: you can buy gold at Costco very conveniently, and they're going to give you a really great price. But Costco's not going to buy it back for you. And if you do want to sell it, you're going to take a huge haircut on it. It might be 5 or 10%, but it might be 10 or more, might be 15%, depending on what's going on in the markets. So gold is the type of market that's really tough to actually liquidate if you're holding the bullion, or if you're holding a gold ETF and you don't want to pay taxes, you don't want a taxable gain, you can do something like this. So this is what's called a risk reversal. And the idea is when the market's this off the rails and just kind of parabolically moving higher, this is a daily chart, so it doesn't look parabolic, but if you zoom out to the weekly or monthly, you can see this is actually a really obscene rally. And the nice thing about it is, though, if you do have some gold to hedge or you want to play the downside, the call options are very expensive. They're overpriced. And the put options are pretty cheap because everybody's convinced themselves gold can only go up. So I want to buy calls and nobody wants to buy puts. So it leaves a price discrepancy. And so we were suggesting people sell February 4,400 calls. The market now is right around 4,000-ish. So we're still about $400 out of the money. Again, wish I would have waited a couple of days because this would have been a much better trade today than it was then. But I still believe in the end it's going to be a good trade. And I'll show you kind of how the math would work. So the idea of something like this is you're selling the call option to use the market's money to buy your put. Sorry, I scrolled too fast. I don't know if you can see this, but the call option was sold for $32 and the put was purchased for $18. So anybody that put this on got a credit. So they collected roughly $1,000 to $1,400, or some got less. The market was moving so fast, some collected quite a bit less, but basically they're taking the market's money to put this trade on. The risk is above 4,400. So if you don't own gold, if you're doing this as a speculation, and the market rallies above 4,400, you've got a problem because you have unlimited risk. It's like being short a futures contract from 4,400. But there are ways to mitigate that. What we generally do is, if we're wrong and we start to get into trouble on something like this, we'll buy micro futures contracts to hedge it and kind of delta out so that we hopefully can keep up with the delta. And what I mean by delta is, the delta is how much the option moves versus the futures price move. So we can actually get to a situation where we're short a call and our position is pretty neutral because we've bought micros against it. That's a little complicated, but if you are interested in that, you can check it out in my book. So let me go back down to the math here. So again, we're selling the call and then using the market's money to buy the put and to also bring in a little extra cash. The margin's about 8,200. I'm going to just say this. Obviously I'm a commodity broker, I'm biased, so we do offer exchange minimum margins. This is the exchange minimum for that position at the time we put the trade out. It's probably a little higher now, but most brokerages will upcharge it. Most brokerages will actually charge you more than what the exchange minimum is. So I'm just warning you. So if you put this into a different platform, you might see that the margin's higher. And I'm not recommending this this isn't a recommendation. This is an educational purpose presentation, but I just want you to understand what you're getting into. And again, it's unlimited risk above 4,400, and anyone that's traded gold knows naked, long or short can be unpleasant at times, so be careful with that. Because you're long a put with nothing impeding it, there's theoretically unlimited profits. So if gold drops below 3,500, it's like being short a futures contract from 3,500 with unlimited profit potential. When we put this on, this had about 117 days to expiration. So that gives you kind of an idea of some of the things that we would do. And you can do this exact same strategy to hedge S&P 500. So I'm going to go to an S&P trade. It's a little bit different, and we were also pretty early on the S&P. We put this on at least a month ago, so you can kind of get an idea. We're taking a little bit of heat on it, but if you wanted to hedge an S&P portfolio, you could do something like this. Options are eroding assets. So if you sell options to pay for options, you're using the market's money to buy the option that you want. The great thing about this is you're not spending your money, you're spending the market's money on options that are going to erode over time. The bad part is you're accepting unlimited risk to do that. In this case, selling a 6,900 call pays for a 6,000, 5,500 put spread. Now again, this is a handful of weeks ago, I think probably 4 or 5. Again, wish we would have waited, but this is an art, not a science. Sometimes we're early, sometimes we're wrong. Most of the time when we're early or even wrong, we can kind of hedge our way out of it to mitigate damage, but there's no free lunches. None of this is easy. I'm showing you all the negative things so that when we go on a win streak, you'll be really impressed. But if you had exposure in the S&P, you could do something like sell the 6,900 call, and then you could buy a 6,000, 5,500 put spread, or you might want to just buy a put outright. So there's no right or wrong way to do it. It's just putting insurance in place so that if the market does roll over, you have protection somewhere. I'm going to roll down to the stats on this because we don't have a whole lot of time. But we put this trade on for a small credit, also $450. So the market paid us to put this trade on. As long as the market stays below 6,900, no harm, no foul, everything expires worthless. If you are holding an S&P 500 portfolio, like I said, $350,000 worth of stock would be hedged by one lot in the futures markets. So let's say you hold $350,000 worth of stock and the S&P goes above 6,900. Your portfolio will continue to gain above 6,900 and your option position here in your futures account will lose above 6,900 as if you're short of futures. So what that means is they just cancel each other out. So it's kind of like if you're in stocks and you trade covered calls, it's the same idea. You're not losing above that price, you're just your profit potential is capped. So as a portfolio hedge, this is a really great way to use the market's money to buy insurance, because anyone that has tried to insure or hedge their portfolio with long puts knows that they get very expensive and they're a very, very big drag. So this is a way, again, to use the market's money to buy your insurance, your portfolio insurance, with the caveat of you're giving up your upside profit potential. If you did it as a speculation, this trade, and this is in E-minis. You can do the same thing with micros at 1/10 the cost, 1/10 the risk, 1/10 the margin. But if you did the E-mini, it's a $12,000 margin to maybe make 25 grand plus a little extra. We would never hold the expiration. I mean, in a perfect world, that'd be amazing if you could collect $450 for a trade and turn it into a profit of 25 grand. But the odds of that happening are very slim. Even in a big sell-off like we saw in April, the market rallied back sharply. So if you were greedy and you had a big profit in a trade just like this, you might have given it all back and actually turned it into a loser. So it's usually not a good idea to try to hold the expiration to get the last penny of profit potential. If the market gives you a gift, take it. And we're kind of running out of time here, so I'm going to close it out. Somebody's asking, I'm going to see if I can go through a couple questions here. What is the exit strategy? The exit strategy for something like that is if we get to a certain point on the chart, that would be, it's okay, let me start by saying it's not really a black and white. It's, you have to kind of take what the market gives you. But if we're looking for, let's say, a move in the S&P from 6,900 to 6,600, just I'm totally throwing these numbers out randomly. If it gets to our target, we're for sure going to take something, we're going to take it off the table. But if we get into a trade and the market sells off right away or, relatively soon, we'll start by peeling off the short call, because that's where all the risk is. So we peel those trades apart incrementally, but it's, again, an art, not a science. So this is our website. If you have any interest in following along some of the trade ideas that we put out there, you can see on the right-hand side, there's free newsletter trial sign up, and you can do that here. If you do sign up for a trial and you decide you like it, but you don't want an open account with us, you already have a broker and you're comfortable with your platform, you can go to Substack and subscribe to our Substack. Obviously, you can do a free version, but you're only going to get limited exposure. We charge $25 a month. So for only $25 a month, you can get it. Otherwise, if you open an account with our brokerage, it's absolutely free. Somebody's asking what our book is. Oh, you know what? Let me scroll down here. These are the 3 books that are the most current. So if you're just starting out in futures, if you don't really understand what futures are, A Trader's First Book on Commodities is the place to go. If you want market analysis, seasonality, that sort of thing, higher probability commodity trading. And if you're interested in option trading, this is the one, trading commodity options. Somebody had a comment about local dealers making a market in gold and silver. That's absolutely true. Not everybody lives in a city though, so unless you live in a city, but those local dealers will, there's a bid-ask spread there, and they're going to shave probably 10%, at least 5, probably 10% off the price. So what you see in the cash market or futures market's not what you're going to be able to sell your gold for, especially now. They're starting to get a little tighter because market volatility is dangerous for anybody participating in those. Somebody's asking if I can explain why we're getting a surge in puts and VIX calls, which are, and it's true, this is the S&P has gone up the last 6 days in tandem with the VIX going up the last 6 days, which means as the market's going higher, people are buying puts and spending more money on those puts. We've never seen this before. Can I explain it? No. I mean, I could see why they would want to own puts. Like I said, we're positioned that way. We're taking a little bit of heat, but the reality is this market is kind of off the rails. It's off the rails. So if it can keep melting higher, but if it doesn't, it could be very, very dangerous. So I think people are just trying to mind their risk, and they should be. Somebody's asking if our brokerage is acceptable to Europe, accessible to Europeans. Absolutely. We open accounts for clients all over the world.